So why don't we start? Because a lot of people don't really understand what capital gains tax is. They don't really get it. They've just kind of heard that it's a big, scary, dark thing that happens, and people aren't really sure about it. So why don't we start with that? I mean, what is capital gains tax?
Yeah, so capital gains tax is essentially the tax that you pay on a capital gain, right? Very simply. And so what that means, if we put it in a real estate context, what that means is when you go to sell an asset, so you go to sell a property, it is you make a gain. Generally speaking, if the property has gone up in value from when you purchased it, you are making a gain on that asset. So if we take an example of if you bought a property for 400,000, if in 5 years' time you sell that for 600,000, you've made very simply a $200,000 gain. And so CGT comes into that, where your marginal tax rate as an individual, you would pay that amount of tax on that $200,000 gain, and that would be your capital gains tax in that situation. So it's essentially, if you take it in a business context, if a business makes a profit in a year, they then pay a tax amount on that profit. And so that's kind of how it applies in this sense. But it's basically, if you make a profit or you make a gain on your capital, you need to pay a tax on that.
Yeah. Yeah, 100%. Yeah, and it's the same. The same thing applies. It's not just real estate, right? It's any asset that you buy and then sell for profit. So the same thing applies to shares. And this is actually one of the things that's really frustrated me over the years, is that in the whole kind of shares versus real estate discussion, obviously there's the real estate's illiquid and shares are liquid. There's that discussion. But then there's the selling costs. Oh, it's not real money because it's just locked up in equity. And, it costs you so much to get access to it. When in actuality, that's just bullshit. I mean, you pay capital gains on shares as well, right? So this is not something that is exclusive to real estate. And I think this is just it's this completely ridiculous concept out there that real estate is suddenly encumbered with all of these additional unforeseen costs, and it's so hard to get access to your capital when in reality it's not. It is less liquid, right? And so it could take you, maybe 90 days or whatever, if you did want to liquidate your portfolio or liquidate an asset, to go and realize that, to turn that liquid. Fine, got it. But in actuality, you're going to pay capital gains tax on shares. You're going to pay capital gains if you make a profit, right? You also get capital losses, so you can actually get tax credits. So if you lose money, you can also get tax credits based on that, right? So you're going to get capital loss. So this idea that you're going to pay tax on profits anyway. So just as you pointed out, if a company makes money and makes a profit, guess what? You pay tax, right? Same thing goes, right? To make it very simple. It's not some foreign concept. The only difference with real estate is that you're also probably going to pay a real estate agent to sell the property as well, and you have some conveyancing costs too. But in the grand scheme of things, they're pretty nominal costs, and we'll kind of talk to that in a moment as well.